Everybody has an opinion on how you should spend, save, and invest your money. But rule number one of investing is stop listening to random people on how to invest your money, including a random guy on YouTube. If you won't trust a fat person with nutrition advice, why would you trust a broke person with financial advice? Plus, your financial goals are your goals. They're not my goals, they're not your uncle's goals, and they're not your broke cousin Bunty's goals. That's why you have to start creating your own financial decisions. Listen to other people, but don't just blindly listen to what other people are doing. Stop copying other people, learn how to invest, and then apply the best information to you instead of just blindly following somebody else. Because even if you blindly follow somebody else, you probably won't see the same returns as them. People try to blindly follow what Warren Buffett's doing, but nobody gets the same returns as Warren Buffett. Number two is remember that what goes up also goes down. No asset class can go straight up forever. Not Bitcoin, not artificial intelligence stocks, not housing, not even tech stocks. By the time you hear about the next big stock in the news, chances are you already missed the big money-making opportunity. Not to mention that our economy moves in cycles. Recessions are a part of our economic system. We saw a recession in 2020. We saw a recession in 2008, 2000, 1991, 1981, 1980, 1973. You get the idea. Recessions happen. Our economy goes up and our economy goes down. And when you start trying to chase an asset class because you see it running up in value, the news is covering it, all of your friends are making money, well, that might be a time where you want to take a step back and just watch what's happening instead of trying to jump in, trying to chase the hype that everybody else is throwing their money into without really understanding what they're buying. If you've watched any of my other videos, you've heard me say that investing has risks. You're never guaranteed to make any money when you invest. In fact, you will probably lose money at some point because that's what investing is. It is risky. And so now when you go in trying to invest your money, trying to grow your money, you have to understand that there's a chance that you could lose all of your money. There's a chance that your investment could go bankrupt. There's a chance that your investment will go down to zero. If you don't have the financial backbone to potentially lose that money, then you're going to be very stressed trying to understand what's going on in the markets because investments go up and they go down, and when they go down, you don't want to be the person that's panic selling. Not to mention the fact that if you go out and start investing with debt, whether you're using debt to go out and invest in real estate, whether you're using debt to go out and buy or invest in your business, or whether you're using debt to invest in stocks through margin, debt amplifies risk. I do not recommend any beginner investor to go out and start taking on a whole bunch of debt and start using this money to invest, because the whole pitch of investing with debt, whether it's in the stock market or anywhere else, is debt will allow you to amplify your returns. But the part that you're missing with that is that debt also amplifies your risk. If you take $1,000 and you invest this money into the stock market, the most you can lose is $1,000. But now if you invest $1,000 of your own money and now you invest $5,000 of your stock brokerage's money with margin, now you can lose way more money than what you're putting in. Yeah, you could double your money and make a whole lot more money because now you can double $6,000 into $12,000 and most of that money is your profit. But if you lose all that money, now not only did you lose all the money that you put in, but now you owe money to your brokerage. Debt amplifies risk. And if you don't know how to invest your money, or if you're not willing to take that risk, or if you don't understand that risk, do not use debt. And this brings me to rule number 4, which is that more risk comes with more potential return. Now, if you do want to know how to invest your money smartly, my team at Briefs Media put together this amazing ebook titled How to Build Wealth as an Investor. This ebook will walk you through things like how do you build the mindset of an investor, to how do you save your first couple $1,000s, to how do you start investing your money, what are the different ways that you can invest your money, how do you invest for cash flow, how do you spend your money smartly, how do you earn more money smartly, how do you protect your assets. There is a ton of value in this ebook, and you can read this ebook for free. So if you want to download this ebook, I got the link to how you can download this ebook for free down in the description below, or you can go to briefs.co/ebook. If you go and save up $10,000 and you take all 10 grand and you put it into a safe and you lock it, the money is going to be safe, but you're not going to get any return. Low risk, low return. Now, if you take that $10,000 and you throw it into your business idea, that $10,000 could turn into $1 million business idea, maybe even $1 billion business idea, but that $10,000 could also go down to zero. Higher risk, higher potential return. Now, what you have to analyze as an investor is what is the right level of risk. Now, when we talk about investing, I'm talking about taking your money and putting it into some other asset that you don't have to actively monitor and operate. This might be something like managing rental properties, because now you can have a management company that does the work, or putting your money into things like stocks. Now, even within real estate and stocks, there's different levels of risk with the types of investments that you'll invest in. For example, if you go out and you invest in stocks, investing in individual companies is riskier than investing in index funds. And now you got to manage your risk and your returns accordingly. Just like that when it comes to real estate, if you're investing in distressed real estate, that comes with more risk than investing in turnkey real estate. Properties that are already renovated, that are already rented out, that's going to be easier to manage because you're already generating the cash flow versus a property that's beat down, that doesn't have any tenants, that has a whole bunch of problems with the property. That's going to take more risk, but the potential to make more money. Now, are you guaranteed to make more money? No, but higher risk comes with higher potential return. Number 5 is buy the asset, not the hype. The first recorded financial bubble in history was a concept called tulipomania or tulip mania, which happened because investors started buying tulip bulbs, yes, tulip bulbs, not because they wanted to buy the actual flowers, but because they were hoping that they can make a lot of money flipping the contracts to buy and sell these tulip bulbs. So now what you saw happen was tulip prices went through the roof, again, not because people wanted the flowers to plant, but because they thought that this was a way to get rich quick. When you start buying this asset because you want to make money as opposed to owning the underlying asset, that's what builds bubbles, and that's what creates these huge booms and busts. When you go out and invest your money, whether it's in stocks, you have to look at the underlying asset, the underlying company or the underlying companies that you're looking to invest in, as opposed to just seeing the stock price running up. If you see the stock price going up, that's good, or it could be good, but the thing that you want to pay more attention to is what is the underlying asset that you're buying. Because what a lot of people are buying is the hope for this thing to make more money without actually understanding what the thing is that they're buying. And that's the key to actually making real money as an investor, building the long-term security as an investor, is you're buying the asset, not the hype. Rule number 6, trading is not investing. You might have heard people say that it takes money to make money. Well, that's a lie. It takes money to grow your money, but it doesn't take money to actually earn the money. When you're investing your money, what you're doing is you're trying to grow the money that you've already earned. So if you don't have any money to invest, you can't invest your money. Now you might hear people on the internet talking about how you can invest your money with no money by trying to do this thing like stock trading or flipping real estate. Well, that's not investing. That's trading. Trading is a way for you to earn money. When you're trading, you're spending your time trying to get this income. Now, when you get this income, that's when you can invest it to try to grow this money that you've already built. But investing means you're taking the money that you already have and now you're trying to grow that money. Earning money means you're putting in an effort, you're putting in work to actually generate some money. So when it comes to investing, you need money to invest, but you don't need money to try to earn money. Rule number 7 is that taxes matter. What you want to pay attention to now as an investor is also tax and how that plays a part in your investing portfolio strategy, because one of the biggest expenses for all Americans are taxes. And this is where you understand is how taxes will play a part or eat a part of your investment portfolio. For example, if you are investing your money for dividends, I love investing my money for dividends, you have to understand that taxes also apply to that income. So if you go out and you own an investment portfolio that's paying you, let's just say $10,000 a year in dividend income, well, you can reinvest all $10,000 back into your stocks, so you buy more dividend paying stocks, but you still have to pay taxes on the $10,000 worth of dividend income, even though you might never see that money. Just like that when it comes to real estate, one of the reasons why real estate investors love investing in real estate is because of taxes. The real estate tax code allows you as an investor to file what's called a depreciation deduction. It is a paper write-off on your taxes that says you deserve a tax break because your property is 1 year older, period. And this allows some investors to make money, to make a profit, to have cash in the bank, and then pay little to no money in taxes legally. That allows you to keep compounding and growing your money without having to pay some of this money in taxes. Because the more money you can invest, well, the more money that you can have growing for you. And this is where now you as an investor want to make sure you understand how taxes are playing a part in your investment portfolio, because if your money is being eaten away by taxes, well, then you might be the one paying the price. Number 8 is you have to know your goal. And this ties into the first thing that I talked about, which is don't just blindly listen to random people. You have your own goal when it comes to investing. For me, my primary goal when I invest my money is generating cash flow. That's why the bulk of my investments are cash flow producing assets. But not all of my investments are for cash flow. I have some investments that are more on the speculative side, like I invest in some startups. They don't pay me with cash flow, but they're more fun for me, and I also understand the risk, but they're more on the speculative side that hopefully they will be able to grow in value and make me money because maybe some of these startups will get acquired one day. That's the goal with startup investing. And so now when you go out and invest your money, before just throw your money into the stock market, know how it is you want to get paid. Are you looking for growth? Are you looking for slow and steady growth? Are you looking for fast growth? Or are you looking for cash flow? And if so, how much cash flow? And if so, do you want growing cash flow? And if so, do you want steady cash flow? You have to start asking these questions because, again, risk plays a part with the return that you're going to get. And the type of goals you have are going to determine how you want to get paid. And when you understand this, that can completely change the way that you're going to do your investment analysis, because you want to make sure that you're investing in something that aligns with your goals. What's a good investment for me might not be a good investment for you. And what's a good investment for you might not be a good investment for me. Rule number 9 is understanding that money flows to the patient. Warren Buffett likes to say that the stock market is a device that transfers money from the impatient to the patient. And what that means is you go through these cycles in the economy, but we also go through boom and bust cycles in every single asset class. Stocks, real estate, cryptocurrencies, startups. It doesn't matter what you're talking about. Every asset class goes through these booms and busts. And what happens is when you are in a particular part of the cycle, everybody thinks that this is going to stay forever. When I first started investing in real estate, it was 2011. And I knew nothing about investing. I knew nothing about real estate. I did not have any real estate mentors. I didn't even know that you could invest in real estate. I didn't know anybody that was investing in real estate. I just started investing. But the sentiment at the time was that real estate prices are going to stay low forever. Nobody's going to ever want to own a home, and home prices are going to be depressed for the rest of forever. Well, clearly that didn't stay the case. As real estate prices started to go up, well, then you start to hear the opposite. You hear people talking about how real estate prices can only go up, how real estate prices can't go down, how real estate prices are going to always be high. See the same thing with stocks. When you start to see a boom in any asset class, whether it's artificial intelligence or tech stocks, when things are going up, you hear about how this asset class is going to change the world. It's going to revolutionize things, and this is going to only go up from here. When it's going down, you hear about, oh my God, it was so overvalued. This bubble is over. This asset class is done for. No one's going to ever use this again. I mean, if you remember back to the 2000 dot-com bubble bursting, a lot of people thought that the internet, quote unquote, fad was done for. And because it was done for, people thought that nobody would ever use the internet again. Well, we all know today that's not the case. But this is where there's a lot of emotions when it comes to investing. And your job as an investor is not to get caught up in the emotions, but pay attention to the underlying asset class and invest with financials rather than emotions. And rule number 10 is to remember that failing is a part of the process. The kind of ironic thing about investing is sometimes you could do everything right and still be wrong. And other times you could do everything wrong and still be right and make money. And this is where you have to understand that there's this element of risk when it comes to investing that's sometimes out of your control. Like you could go out and invest in what you think is a great company, a great investment, a great sector, and then a new president comes in and they create this new regulation that essentially makes the industry that you just invested your money into bust. It makes it void. And that could severely hurt the value of your investment and the chance of you to ever make any money. And this is where you have to understand that investing comes with risks, and there will be times that you lose money. Not there might be times that you lose money, but there will be times that you lose money. But the key is to keep coming back and understand that the goal is to make way more than you lose. Losing is a part of the process. Every successful investor in the history of time has lost money at some point. It's not just you. And you have to understand that the key now to making more money is to keep coming back and keep learning because, well, losing is a part of the process. And again, if you want to keep enhancing your financial education, I have tons of videos on my channel, and you can also check out the ebook that we have at Briefs Media down in the description.
US News put out this article on what they call the 7 best dividend-paying ETFs that you can consider buying. Here are the 7 ETFs that they recommend, and again, investing has risks. Make sure you always do your own due diligence and never blindly follow a random guy on YouTube. Number 1, SCHD, which is paying out 3.6% a year in dividends. VY